Hello, everyone. This is so incredible. What a space. Thank you so much, WeWork, for hosting this and Onstage for having us here. I'm going to quickly start off and introduce myself, and then the focus will be on Tim for the rest of the conversation. For those of you who don't know me, my name is Jamesin. I'm a partner at an early stage fund called Chapter One. I have a background in data science and sports betting, and I'm really looking forward to this conversation. Awesome. Okay, so to get started, would you be able to give your background, talk about Yonder, and a quick overview?
Yeah, also firstly, I would not be able to afford this space when I was a pre-seed founder. But my name's Tim Chong, one of the co-founders and CEO of Yonder. We're a rewards credit card. I've been around for about 4 years now, raised over £40 million in venture backing over the last couple of years. So if you haven't seen us, go to yonder.com. Basically, give me some free CAC, please.
I love it. Okay, we're just going to get right into it. So the panel is called What to Expect When You're Expecting to Raise. And so I'm going to start off with a question about fundraising. So Yonder has done crowdfunding, and then you've also raised from some of the top venture funds in the world, North Zone, RTP, Local Globe, and Seed Camp. So can you just describe that journey and what the various methods of fundraising that you've used?
Yeah, I think the first thing I'd say is that fundraising is, I've had some easier raises and some hard raises. That's sort of like, I've done 4 raises now. And one of the observations that I got advice from actually Matt Robinson, who's now at Excel, and he said to me, Tim, fundraising is often not a reflection of your business, but a reflection of the market. And that was super insightful because I think oftentimes a good fundraise, you might think you're doing very well, and conversely, a bad fundraise, you might think you have a bad business. Now, I think it is somewhat correlated, but I actually think that it is a lot more correlated to what's going on in the market. Our first couple of raises were really easy. The market was really frothy. There was basically like, you're doing fintech. Great, here's a term sheet. And then it was like, oh, NASDAQ collapsed. You're doing fintech. We don't want to do fintech. And you're like, the business hasn't changed in 6 months, and yet like fundamentally the market's changed. And so I think that was super insightful because I think if you go and build like a great business, every single founder I've spoken to who have built great businesses have said some fundraisers are great, some are really hard. And that was a very helpful way of thinking about the fundraising process because I think you can hear about this AI startup raising 10 on 100 and being like, why can't I do that? It's like, well, it's because AI is hot at the moment. Or I'm now doing defense tech, and now all of a sudden they're raising really easily. But it'll be 3-4 years, and all of a sudden it will be a very difficult sector to raise in. And so I think, to the extent of almost like ignore the noise. The second thing I think a lot about is price is an outcome of supply and demand and nothing else. And a lot of people are like, well, what valuation are you aiming for? And I'm like, I'm not aiming for valuation. It's fundamentally supply and demand. Focus on making sure your company is well capitalized. I have one job as a CEO, make sure we don't run out of money and make sure we're well capitalized to build what we want to build on a 10 or 15 year horizon. Valuation will come as an outcome of, do you have a competitive round? If you're in growth stage, multiples will start to matter, but early stage, it's really supply and demand, right? Like nothing really matters early stage. It's really supply and demand. And so just focus on, look, don't anchor your fundraising process on evaluation. Just focus on how much capital do I need to raise. And then kind of let the process figure that out. And you'll hear so many stories of, oh, the valuation like tripled over an 8-week period. By the way, your value of your company has not fundamentally tripled, just demand has gone up massively and your rounds become hot and all of a sudden you can raise it at a high valuation. And I think thirdly, again, if I think about early stage, it's a process. Fundraising is a process. Don't always be fundraising. I think you can build relationships and things like that, but quite frankly, I think you should either be fundraising or not fundraising. And when you're not fundraising, you should be focusing on building businesses and talking to customers. If you are fundraising, then go and speak to as many investors as possible. But I would say something quite contrarian, but a lot of VCs are like, build a relationship with me, get to know me before. The problem is, at sort of seed round, you could be speaking to like 100, 200 investors. Where do you have time to go and talk to customers and find product market fit? And so my general view is that, especially at early stage, it is somewhat a FOMO-driven process. It is somewhat driven on, look, seed investors are putting in 20, 30, 40 investments per fund. They will move quickly if it's a hot round. And so this whole notion of like build a relationship for 2-3 years, I just don't subscribe to that. I think it makes sense when you're doing £100 million growth rounds. That's a very different story, but especially at this very early stage, I think run a process, speak to 50, 100 investors in 2-3 weeks, and run a really tight process. But don't waste your time with VCs like, hey, get to know me, and because what they're going to do is just essentially create optionality for themselves. They'll kind of drag their feet and be like, yeah, keep me posted. Let me know how traction's going. Look, let's be frank. Pre-seed investment isn't betting on a team. They're not investing in traction. And so if they're saying, let's get to know each other, let's hang out, it's really like, let's give me as much information as I can and make sure that I can kind of get optionality, but you're not going to maximize your chance of getting good rounds.
Yeah, I think that really insightful, like the idea about running your own process, staying focused on customers, and then going out to raise after that. How do you think about knowing when you're ready to go out and raise? What are venture funds looking for when they're thinking about pre-seed and seed stage companies?
So my view at pre-seed is just betting on team. I think any great pre-seed investor is it's just about the team. So I think in terms of when are you ready, well, whenever you need the money, go and do it. Well, I've had two guys from my team who have both left to start companies as well. They left with just a team. They both raised £1.5–2 million pre-seed rounds. And they had literally nothing except a great team. And so I think at the pre-seed stage, and the same with us when we raised our first round with Local Globe, C-Count, we were pre-product, we were pre-everything. We just had a team. And so I think at the pre-seed stage, it is really fundamentally betting on team. Seed stage, it's a funny one. It changes for different venture funds, changes on the sector. I think if you're AI and you have a couple of people who've worked in AI before, you can do a 10 million seed round. It's a really funny one, isn't it? I think I go back to the fundamental thing. Venture capital funding is about, fuel to go and achieve a milestone. So when you need the fuel, then you need to go and do the raise. It's really tricky to have a definitive answer because it depends on the sector. I think if you ask every single seed investor who's listening to this in this room, everyone's going to have a slightly different definition of when a company is seed ready. Some would argue you need some MVP. Some would argue you need to have signs of PMF. I don't know, to be honest. When we did our seed round, it was when consumer fintech was trading at like 25x revenue multiple. So we had none of those things. And we had a really great round. But I would say that it would be naive to think that would be the exact same situation today because it's not as hot as AI or defense tech at the moment. So I just gave you a very wishy-washy, useless answer. But I think actually a lot of it is market dependent. And I think what I try and do is do this sort of thing of like price discovery. I'll take like a couple of like informal chats, very time boxed, and just sort of get a sense of like, I won't ask them what do you need to see because everyone will give you a slightly crappy, useless answer. But I'll sort of be like, hey, I'm looking at going out to raise, we'll probably be at this. And you can kind of get a sense of like, oh, it's probably too early for us, maybe for the next round. Or they'll be like, oh, actually, that will be very interesting. Can you give us a heads up? So you can kind of like qualify in, qualify out based on like, when you want to do like proposition testing, you don't ask customers, hey, what do you want? You kind of like show them what the product will be, and then you kind of get a response. And you can kind of get like a visual response from the person. I kind of do that with like investors and sort of be like, we reckon we're going to be about here by this point. Let us know if you're interested, but if not, no worries. We'll kind of stay in touch. And you can kind of get a sense of like, hey, that's actually a sweet spot for us. And some of them are like, actually, that's not really a sweet spot for us at the moment, And so I kind of use that approach to fundraising as well.
Makes sense. And so there's obviously the kind of traditional way to build a business where, you're taking out a loan and then you're trying to get cash flow positive and you're paying back that loan. And then you have the venture side where, you're giving up a piece of your company and kind of the second you take venture money, you're on that hyperscaler path. I get asked all the time, what does that middle look like when when you want to start a tech company and you're not ready for venture money? You kind of want to raise an angel round or maybe an accelerator, but it's still kind of, you're not really sure what your options are. For that in between where it's not necessarily a traditional business, but you're not really ready to raise a pre-seed or seed, how do you think about that stage? And do you have any kind of suggestions or recommendations or thoughts around what the options are there?
Yeah, I definitely say don't take venture funding unless you know you want to build a venture business. It sounds so obvious, but I've got a lot of friends who have built great businesses that are not venture funded. The best analogy is venture funding is like rocket fuel. If you're building a rocket, take venture funding. If you're building a race car, take great race fuel, but don't take rocket fuel. And so, there are great angel investors that will write big checks. Some of our investors wrote 100K angel checks, and their risk profile is quite different. But I think just make sure it's a partnership, right? By the way, once you take money from someone, you're stuck with them. You're in a marriage with them. And so you have to kind of know that you're on the same page of what you want to get out of this relationship as well. We did a lot of due diligence on our investors as well. When we raised money, I grilled them and said, introduce me to your worst performing portfolio companies. I want to go speak to those founders. I have zero interest in talking to the best performing portfolio companies because that's obviously going to be a great experience for everyone. Tell me about your worst ones. Tell me about the ones that struggled for a bit and then took off later, because startup building is never a linear process as well. But I think about capital pools as really the right capital pool for the right type of business as well. And then one of the things I always think about is venture economics is power law. It's, at a seed fund, you expect probably half to die, maybe 5 to 8 to return 1x, maybe 1.5x, and then you need 2 to 3 massive outliers. That's how the economics work. Whoever's investing in you is looking at your company through that lens. They're not bad people. They have a fiduciary responsibility to their LPs to generate a return. And when you are in a portfolio, your investors are stack ranking you and saying, are they in the 50% that's not going to make it? Are they in the 30 to 40% that's going to return a 1x? Are they part of the 10 to 20% that's going to return the fund? That's how they're thinking about things. And I don't think that's a bad thing. I think to an extent, you are custodian of your investors' money as well. And so just like recognizing that's how they look at the world as well. And you are an option chip for them as well. I don't think that's a negative thing. That's just reality. And so just think about what kind of risk profile you want. If you are going to take venture capital funding and you want to build a 10 million revenue business, you shouldn't take the money. There are some great private equity funds that are built for that mid-market outcome. And angel investors are a great sort of, let's say, interim step before you figured it out. But I do recognize that if you need to start raising 2, 3 million, 5 million, you kind of really only have two options. It's like venture capital or sort of like mid-market private equity. Private equity, they want to probably see some free cash flow, so you can't really do that either.
So I want to talk about culture and teams and scaling Yonder. You are at 110 employees, which is just absolutely incredible.
Shit, 55.
Oh, 55. Oh my gosh, I got that information.
All right, no
okay,
worries.
55 employees. Still incredible. And you wrote in one of your blog posts, I've realized at 30 people, I can create more impact by helping the team be 10% more effective than working 100% harder. And of course, in startups, each hire is the culture. And you spoke about there's the marriage between the founder and the investor, but there's also a marriage in your team because everyone works so closely together. How have you thought about scaling the team, and what has your hiring process been? And how do you make sure that you're hiring the right person?
So there's like compound questions. There are 3 questions I'll sort of answer there. One is the different stages. 2, hiring at early stage, or how do you actually hire the right team? And then I'll talk a bit about the hiring process. I think the first thing that I observed, even over the last couple of years, is this transition from building product to building team to then building the organization. And they are quite different. One is like you're hands-on building a product, and that's what you need to be at that sort of early stage, like 0 to 1. And I'm a product person by background, so I love that. And then the next stage is building the team that then also builds the product as well. And so I kind of describe that up to, 15, 20 people. And then, then I kind of describe the next stage as like building the organization. And I describe it as like the organizational systems, the processes, the organizational rhythms, the patterns on how you run your organization. They really matter. And at 10 people, you kind of just stand up and yell in the room and say, we're doing this. When you're like 50, that's really annoying. that's like not a good way to manage a company, because it can become very all over the place as well. And so that was sort of the one adjustment that I felt like I've had to make. And when we get to 100 to 200 staff, that will look again very differently as well. And so I think the first thing is just recognizing your job as, especially as a CEO, is very different across the different stages. I think it's also quite of a weird one in that when you're a co-founder, you're automatically assumed to be a CEO. They actually are not the same job. The co-founder and a CEO is not the same job. And so you kind of have to think about your job in like two different hats. The co-founder is like this custodian of this company where you like birth this dream, and the CEO is like building an organization. And they are different jobs. And so I think about my job as a co-founder and a CEO slightly differently all the time. I think that the second one is, I guess our philosophy at the early on in hiring is that, let's say you're two co-founders, your first two hires will represent 50% of your culture. Your next 4 hires after that will represent another 50% of your culture. And so think about it in the lens of, okay, if that is true and culture is important, then how much more effort should I put into making sure I get those hires right? That's my philosophy. There are many philosophies. One school of thought is just hire anyone, bring them in, and then if they're not the right fit, get rid of them. Our sort of school of thought was every early hire has a disproportionate impact on our culture and the culture that we create. And secondly, they will go and hire the next 20, 30 people. And some of our most early hires have been responsible for hiring our next 20, 30, 40 people. They're the ones training our other team members how to hire as well. And so, we spent a lot more time up front on the hiring side. Whether that was right or wrong, I don't know. I don't have the counterfactual, but that was something that we thought about. And I think the third aspect is being really, really rigorous in your hiring process in terms of what do you really care about and what do you not care about, and make sure that you basically, we kind of had this philosophy called compel and repel, which is we want to compel the people who are the right people for us and repel all the people who don't want to work for us. And I'll give an example of that. I actually asked people in an interview, and I said, do you like working hard? Do you love working really hard? Because if you love work-life balance, don't come to our company. And that is not a rude statement. That is just, I want to give you a chance to opt out right now. And part of what I want to do really is let people opt in and opt out as early as possible. And so I think we were really clear on that. I think secondly, look, I'm not going to go through. There's a whole number of great books on how to hire. But most people don't bother spending the time to read them. So when we started the company, I spent a month. I think I read through 5 different books about hiring. It was the book around how Google hired, how Netflix hired, blog posts from First Round Review on hiring. Literally, I just scoured the internet for just general advice on hiring, because I think that the core premise is that most of us suck at hiring. Just assume you suck at it, because it is a skill. And therefore, like most skills, when you first do it, you generally suck at it. And the only way to get better at it is to practice. The problem is, as you're practicing, you're also making critical decisions for your company. So how do you de-risk that? Well, de-risk that by going to get and learn as fast as you can. It's like when you go skiing or snowboarding, the first time you go, you just constantly fall over. But one of the fast ways to fast track that is maybe getting a ski instructor, or getting someone to coach you, or getting someone more experienced to help you. And you're like, well, we do that for most sports that we play or most professional things that we want to build. And yet for hiring, we kind of all wing it. And then we sort of go, why am I not good at it? It's like, yeah, it's because you suck at it. And that's because most people will suck at it by default. It's a learned skill. And so I generally operate with the premise that everyone sucks at hiring and you have to learn it. And by the way, that's still for me to this date. I think we have a very good hiring track record. We've produced 2 companies out of our company. I would still go with the premise that I still suck at it and I still need to get better at it. And it is a lifelong skill. Because I would only say that you can say you're great at it if you're getting 100% hit rates. And no one does. Everyone misjudges hiring. So the most senior and prolific executives in the world make bad hiring decisions. And so if that is true, then you have to follow the premise that you have to keep getting better and you have to keep working at it. And so for me, it's a continual work in progress process.
It's a very humble response, because I've met a lot of people that you've hired and they're all super geniuses. You have a real PayPal mafia type of thing at your company and coming out of your company. And so when I was at Twitter, it was kind of this thing where we would hire someone, and then about 6 months to a year later, they'd be poached by Stripe or Facebook, and they would get a 50% salary increase, and it would be extremely frustrating because we had trained them, and then off they were to make a lot of money. And so in the startup world, obviously you guys are. It's difficult because you're not only competing with other startups, but you're competing with big tech in terms of salaries and also team size and everything else. How do you think about hiring at specifically a startup and competing with the Google for the same engineering talent that they're also trying to recruit?
I think it goes back to like what other people you hire for looking for. None of our team were looking for that. So one of them left Amazon, one of them left another large consumer fintech. They were opting out of that. So I think going back to this kind of core premise, don't join us if you want to be at a company that's about to IPO in 2 years. We are not the right company. Don't join us if you want a massive salary. Go to Amazon, go to Google, go to Meta. But we're great if you want to be part of building something, like not being a cog in a massive machine and be part of really building something. You want to be part of having meaningful equity, and you want to go make a difference. That's what we found. And those who didn't want that opted out very quickly. And I think that's the thing I always back to. If you're interviewing at Google and a early stage startup, why are you doing that? Like, what is wrong with you? Because you just want a job. In which case, early stage startups are like objectively terrible, right? Like, you have bad salary, you work longer hours, you have less process, the startup will probably die. Like, it is a terrible deal, and yet the people who love that, love it. Yeah. Like, all our team, most of them are just like, I love it. I love the craziness of it. I love the fact that, everything's on a bit of a knife edge. I love the fact that every single day, if I work a day faster, I make a difference in the company. If you work at Google, you work a day faster, it doesn't make a difference. This company's generating free cash flow like continuously. And so I think it's a bit of like a self-selecting effect. I would say that if you're losing someone to, Meta or Google, great. Like genuinely, as in not in a bad way, but just like, that's so great for you. We're not the right company for you. And I think that's the thing that we've always been really clear on, is that we're not the right company for everyone. You can just go to the other company. Like, I would encourage them to leave. And even the two guys that founded companies, I could tell they had an itch. And I was like, guys, what are you doing here? Like, don't stay. This isn't good for you. It's not good for us. It's not good for you. I could see it in their eyes. There's like this fire in their eyes, and they were itchy. And the worst thing I can do is have someone 50% in. I'd rather 100% in or 100% out, because it actually dilutes the quality across everyone else. And so I said to them, hey, I actually think you need to go and chase your dream, because I am not doing a great job as a CEO holding you back from that. So like, go. Like, go. I'm going to go help you fundraise. I will provide references. I will support you on that journey. We put in a small amount of money in these companies as well. We're like, go and do great things. And we feel that about every single person at this company. Not everyone at this company will not be here for their entire lifetime. It is completely unreasonable. They'll be here for 1, 2, 4, 8, 10 years. And my job is to make sure that we're great stewards of them being here, and then go and support them and go doing other great things as well.
I mean, that's really great leadership on your end, to almost so supportive to just say, go start the company, follow your dreams.
But I think it's like I'll be pretty blunt about it. Commercially, it's a better thing to do as well, because they're not hungry for this company anymore. Yeah. And so I think you need that infectious hunger to be across the organization. There's this concept called like talent density. I didn't pioneer it. It came from the guys at Netflix, and they talked about this idea that the performance of, if you have a team of 10 people and one person who represents 10% of your team is sort of underperforming, your team performance will go down by more than 10%. It will drag down the quality of everyone else. And so I think about it in that lens as well, both in terms of passion, but also performance.
I want to ask you a few questions about becoming a founder. Becoming, as you've kind of been talking about, becoming a founder, it's such a different beast than working at a big tech company or joining an investment bank or whatever it may be. What gave you the confidence to become a founder?
I kept having ideas that I wrote down, and I never did. I actually wrote down the idea for Ramp or Brex in 2011, actually. I wrote it down, I use Evernote. I'm one of those dinosaurs. I was a consultant, and I still remember being like, why hasn't anyone built an app on an iPhone or a smartphone that lets you take a photo of your receipt and upload it in 2011? And I never did anything about it. This happened again many other times where I'd write ideas down and great companies will be built out of it. And so I said, okay, I think my intuition for finding consumer problems or finding opportunities is actually pretty damn good. And I would describe it as like this insatiable itch that I said, if I don't do this, I will regret this my entire life. By the way, just to be clear, I went in knowing the odds. Like, I went in knowing that like 99% of startups don't go anywhere, but I didn't care. I was genuinely like, the worst case scenario is I go back into consulting. Like, if I really get desperate, I'll go back to consulting. But I have to scratch this itch. So a bit of it was just, I'm 30, I'm not getting any younger. If I don't do it now, when will I do it, basically? So it was more of that, to be honest. I didn't go in with this big conception that I'll be successful. It was just, let's just give it a solid crack. And whatever happens, we'll have a lot of fun and we'll learn a lot. And, you know, the opportunity cost us maybe 4 years of salary. I mean, it's not that big a deal. I've got a long career ahead of me. So yeah, it was a bit of that. It was just a bit of conviction that my gut was pretty good. I think I was really good at executing. So my 2 co-founders, we also worked together. My CTO, we worked together for 7 years now. And we were, I would describe, probably one of the best executors at the last scale-up I was at. And so I had a lot of conviction in our ability to execute, and also in my conviction, sort of my ability to spot sort of consumer insights and find a product idea there. And so I said, look, if we've got those 2 things, what else do we need? Let's just give it a crack. But you know, it was, quite frankly, a bit of it was like, we don't have kids yet, so we should do it before we have kids.
When you think about like kind of when you started the Yonder back then versus now, and this is gonna be one of the last questions, so I'm really curious, kind of your thoughts around this. Like what, I guess, like when you look back at that time, what's easier about starting a business now than back then? And you know, you kind of mentioned the opportunity cost for being a founder. Do you still think like that? You know, when people are kind of thinking about becoming a founder or thinking about joining a startup, yeah, what's changed?
I think the ecosystem is just getting better and better.
Yeah.
I think that there are more great investors, there are more great operators. I think obviously AI makes it quicker to build MVPs. So I think in general, it's easier to start. That does mean more competition, but that's fine. And I think the other thing to think about is, what's the opportunity cost of not doing it? And I think my view of the world is that my biggest asset is my time. And every minute I'm not starting a startup was a waste of time. That was the way I thought about the world. I was like, every minute that I'm working another job is an absolute waste of time, because I have an opportunity cost of, I could go and build something as well. I think the second thing to think about is that you'll learn so much anyway. Like you will learn an incredible amount, but it's not for everyone. Most people shouldn't be founders. Like, the world does not operate if everyone are founders. It will be chaos. Trust me, you don't want there are so many founders who should not be founders. That's just reality. I think because to be a founder, you kind of have to like, by nature, be very irrational, because you have to believe something will work even when it shouldn't. You have to believe something no one else believes in. And the work is a grind. And by the way, I built a model, the expected value is very poor. Like, you'll make more money going into banking than being a founder. Even if you look at the folks who started somewhere like Y, it's like, wow, they made a lot of money. It's like, yeah, but the probability of succeeding was like 0.00001. So by the way, your expected value is very low. It's just like, it can't be about that. It's actually a very bad financial decision to start a startup. Like, go and work in banking, go and work in consulting, go and work in big tech. You do it because you love it. And I think that for some people, not doing it is not even an option. And so that was my conclusion anyway, when I was sort of in my late 20s, not starting a startup was not an option. The only option I had was to start a startup. And so for many of you who are here, like, you will have that feeling of like, there is no option but to start a startup. I've got my friend who's on his like 3rd startup now. And I'm like, why do you keep doing this, man? Like, you're like, this is like, you just suck it. He's like, I just love it. Like, every time it doesn't work out, I want to take my learnings and do another one. And I think this is an element of like, you just love it. And it's horrible and painful, and you'll be more stressed than ever. You won't sleep. You'll be anxious all the time. You'll be constantly stressed. It will feel like you're chewing glass, as some people say. And yet you still love it. And so it's this really weird, paradoxical thing. But for those who have, I guess, this sense of like calling to do it, doing anything else is, I think, a wasted opportunity. And so I don't know, I think you know when you know.
Well, that's an amazing place to end. Thank you so much, Tim, for your time. This has been incredible. And yeah, so cool to hear your insights and learnings.
Thanks so much, everyone.
Awesome. Thank you.